Hi, everyone. This is week 8 in the ACC100 Introduction to Accounting course, and we'll be reviewing Chapter 8 from the textbook, which is all about long-lived assets. So here's a list of 9 things that you should be competent in to be able to respond to your various quizzes and exams. The first thing is to be able to define long-lived assets, along with depreciation expense and accumulated depreciation. You should be able to distinguish between tangible and intangible long-lived assets and probably provide some examples. And as we covered in class, one of the most important capabilities is to be able to determine what constitutes the cost that we can capitalize in respect of a particular long-lived asset. As well, there are a few points here that deal with the notion of materiality, which I'll discuss in a minute, of course. And that's really about ensuring that the cost of preparing accounting and financial information is less than the benefits of doing so. Seems my list has been out of order. We should be able to explain why the usage, the consumption or use of long-lived assets is recorded, which is the notion of depreciation, as well as being able to identify which long-lived assets are not depreciated for accounting purposes and what the reason for that is. You should be able to calculate and record depreciation, particularly using the straight line method. Be able to record the disposal of long-lived assets, including the recognition of any gain or loss on disposal. And then lastly, how these long-lived assets should be presented on a statement of financial position. So in terms of definitions and descriptions, the first one, long-lived assets. First of all, this has to be an asset. So we recall from early in the course, an asset has to have probable future economic benefits. Earlier in the course, we dealt with some current assets or assets that are classified as current, such as accounts receivable and inventory. And the reason they're classified as current is that the conventional notion of current or short term is that they will be realized, their benefits will be realized within the next business operating cycle, which is typically assumed to be 12 months. Long-lived assets are assets whose potential future economic benefits are expected to be realized over longer periods of time than just the next year. And in fact, it may be many future periods. For example, copyrights. When somebody copyrights an intellectual property, the lifetime protection afforded by that copyright extends to 50 years after the date of death of the originator of the intellectual property. So as you can appreciate, some of these assets do last a long time. If you file and receive a patent in the United States, in Canada, or even internationally, the length of time that you have legal protection for that patent can range between 17 and 20 years. There is a difference, however, between the legal life and the estimated useful life. Sometimes the estimated useful life can be less than the legal life, and usually that's due to forces of competition that are anticipated to be able to create a competitive product or property before the legal protection expires. Now, depreciation. Depreciation is the allocation of the cost that we have ascribed to a long-lived asset over a period of time that is expected to benefit from the use of that asset. So depreciation is an application of the matching principle. Think about long-lived assets lasting a long time and benefiting many future periods and having a high cost. The purpose of depreciation is to divide that cost into smaller chunks. Each chunk will be released from the balance sheet and transferred to the income statement as an expense on a systematic and rational basis in order to try to match up the consumption or use of a portion of the asset with the benefits the asset generates, such as by producing products that can be sold and turned into revenues, and then ultimately collected in cash. Now, accumulated depreciation is basically the sum or the summing up of all of the depreciation expense amounts allocated to individual periods. And that accumulation occurs from the date when the long-lived asset is first put into use until either the end of its estimated useful life, or if it comes sooner, the date of disposition. Now, the reason that we have this special account called accumulated depreciation, which is a contra account, is to accumulate the depreciation expense in an account separate from the account where we keep track of the original cost. And the main reason for that is that we often need the original cost amount for tax purposes. So we keep those amounts separately. But accumulated depreciation is entered into a contra account, which, as I've explained before, is married to the host account, which is the account that tracks the cost. And we enter the accumulated depreciation amounts in the opposite sign, so we can add the two married cells together, married accounts together, and create a net amount. And when we present the long-lived asset on a net basis on the financial statements, you know from my previous explanations, anytime you see the word net, it means something has been subtracted. And in this case, what's subtracted from the cost amount is its gradual depreciation that's accumulated over its lifetime to the date that is declared as the reporting date for the financial statements. All right, so here are some distinctions, first of all, by way of description, between intangible assets, which represent physical assets that can be seen, touched, etc., and typically contribute to generating a profit. Whereas intangible assets, and here's some examples, sorry. So the examples of tangible assets, things that you can perceive by the senses. You can touch them, smell them, scratch them, sniff them, kick them, whatever. See them, in fact. They include property such as land, plants such as buildings and factories, and equipment. Now, the intangible assets generally are legal rights that are capable of generating future economic benefits. That's what FEB stands for the owner or the user. And of course, those future economic benefits may be related, just like the tangible ones were, to the contribution towards generating a profit or revenues, okay? Some examples of intangible assets include patents, trademarks, copyrights, franchise licenses, technology assets, and other forms of intellectual property. All right, the third item on our list of what it is that you're responsible to know is how to calculate the cost of long-lived assets. Now, the first notion here is that we are applying the historical cost principle, which generally means we're dealing with amounts that are actually paid. And the alternative is that we're trying to value our assets at a fair market value, which might be different than the amount paid. So we're not talking about fair valuing the assets at the moment. We're talking about tracking our cost. And the question arises, what goes into determining the cost of an asset? And the guiding principle is that cost includes the amount of all or any expenditures that were made to acquire the asset and or were necessarily incurred to get it ready for its intended use. And these costs can be added into the asset's cost account right up to the time when it is ready to be put into use. So some sample inclusions include the supplier's invoice price. If the supplier offers the purchasing enterprise any kind of a discount, then that would be subtracted, because remember, we're tracking under the historical cost principle the amount actually paid. We would also include shipping to the location of use and related costs such as shipping insurance or transportation, goods in transit insurance. Now, the shipping costs still have to be costs that are paid. So the terms of shipment for the equipment, for example, would have to be FOB shipping point. If the terms were FOB destination, then we're not paying for the shipping costs. So they would not enter into our cost of the asset. Any import duties and non-refundable taxes would be added in. So generally this excludes HST or GST because business enterprises get those taxes refunded as a rule. Any fees such as brokers' fees, import brokers' fees, lawyers' fees if we're registering an intangible asset. The cost of installation and testing, including calibration of the equipment, and something called betterments, okay? So betterments are anything that improves the asset by way of making it more efficient or lasting longer. So betterments can occur at the time of acquisition or they can occur subsequently. Now, some things that are not included in the cost of assets include the cost of a warranty. And think about this in terms of the guiding principle. Buying an extended warranty is not essential to get the machine ready for its intended use. General insurance policies premiums, repairs, which are different from betterments, okay? Repair is fixing something and restoring it to its previous level of productivity, efficiency, or life, whereas betterments extend those things. And generally, any expenditures that are made after the in-service date, unless, of course, they are betterments. Now, in terms of the notion of materiality, as I was saying in the opening comments, all information has a cost, including accounting and finance information. So for the information to be valuable, the benefits of that information or of processing it to create the information should exceed the cost. Now, if we expense an item of an expenditure, that has the least accounting cost because it's just a one-time entry into the accounting records of the business. Whereas if we capitalize and depreciate an expenditure, it's more costly because first we have to set it up, and then every year we have to take a depreciation expense on it. So if we're going to go through that process, the notion of materiality comes into play. And basically, materiality is a monetary threshold, which we're saying if the cost exceeds the material amount, then it's worth capitalizing and depreciating. Otherwise, we'll just expense it and be done with it so we don't have to go through that process in the future. So how is materiality determined? Conceptually, it's on the basis of the qualitative characteristic of relevance. So an amount whose presence or absence would change a decision is considered relevant. And therefore, that amount of, like, if you think about, you know, for example, how much would you pay for a cup of coffee? If you're happy to pay, you know, $2, $3 for a cup of coffee, then your materiality threshold for that particular item is like $2 or $3. If you get up to the Starbucks level and drinks are costing you $4, $5, $6, $7, $8, and you draw the line and say, you know, I'm not buying a coffee for more than $4, then that's kind of your materiality threshold. And so what's happened there is you've just drawn a line and said $4 is the limit that I'm prepared to pay for a coffee. So that's kind of the issue of relevance, all right? Now, materiality overrides the other principles. So even though the conceptual nature of an expenditure makes it an asset, for example, a business license, you spend this, it can benefit many future periods, and so it has potential future economic benefits. Conceptually, you can capitalize it as an asset, but the cost of the business license is only $60, and it's really not worth setting it up and amortizing it over a life of whatever it is, 5 years or something. So most companies just expense such small expenditures. All right, let's talk a little bit again about what depreciation is. And sometimes you'll see the word amortization. Now, amortization gets applied to two types of activities. One is the a substitute for the word depreciation when it comes to long-lived assets. and the other is related to long-term debt. Typically in North America, we apply the word amortization to intangible assets and depreciation to tangible assets. Now, as I mentioned before, depreciation is the allocation of an asset's cost to expense. So the asset's cost sits on the statement of financial position. And when we allocate a portion of that asset's cost to expense, we're going to transfer it from the statement of financial position to statement of income for each time period that the related asset is used to generate economic benefits like sales, profits, okay, or reducing costs. And it needs to be done in a rational and systematic manner. And there are alternative ways of calculating depreciation, the most common of which are the straight line method, the units of activity method, and the declining balance method. Which one you choose is really based on a method that reflects the pattern of consumption or use of the asset. Now, one thing to get clear is that depreciation is not a measurement of the decline in the market value of the asset. And yet the forecast change in the market value of the asset through a pattern of normal use is sometimes reflected in depreciation because of its impact on a residual value at the end of its useful life. But that forecast residual value is based on an expectation of consuming or using the asset. And as we consume or use it up, its utility for future use declines, and therefore it becomes worth less to other people. For example, a brand new Mazda 3, maybe we think it has a 10-year life. If you buy an 8-year-old Mazda 3, maybe you think it's only got a 3-year life. And so the difference in the expected remaining useful life is a reflection of how much utility the asset holds. So why do we record depreciation? The main reason, as I explained, I think earlier, is that long-lived assets can benefit many periods, and typically they have large costs. So we don't want to, one of the things that companies are interested in is reporting what's described as a robust measure of profitability, and we like to see some degree of consistency in the measure of profitability over time. So one of the ways we can accomplish that is to avoid a situation where we buy an asset for $100,000 and we just expense it to the income statement in the month we buy it. And then none of the subsequent months in its estimated useful life, let's say it has a life of 10 years or 120 months, none of the other 119 months bear any cost at all. And as you can appreciate, that leads to a huge loss in one month and no matching expenses, and so overstated profits in subsequent months. So to avoid that situation, we take depreciation every month on some rational basis so that we can allocate a small portion of the cost, the high cost of a long-lived asset, to all the periods or each of the periods that are expected to benefit from its use. And we'll do that up until the end of its estimated useful life, or up until the date that it's sold, if that happens to be earlier. Amortization is an equivalent concept to depreciation, typically used for intangible assets. And in the past, in Canada, it has been used also for depreciable assets. But this is not a term we're using in this course. We're focusing on the notion of depreciation. Now, some assets are not depreciated or amortized. And why is that? Well, here's some examples, first of all. Land is a tangible asset that we don't depreciate. It typically has an indefinite, unlimited life, and it's immovable. It's not going anywhere. Nobody can hide it or move it from one province to another. Some examples of intangible assets that are not depreciated or amortized include, again, any asset with an indefinite or unlimited life, such as trademarks and goodwill. And the reason for this is because assets with unlimited lives typically don't get used up or consumed, at least not in the way we can reliably measure. Therefore, there is no cost decline to allocate. And even if there was, such as is the case of goodwill sometimes, it can't be done in a systematic and rational, regular, frequent manner. Just for your interest, one of the things that happens to some of these intangible assets with unlimited lives is that we periodically test the fair value of those assets. And if the fair value is less than our cost, then we will reduce the cost to its fair value. So Julian is asking, what about patents with an expiry? Well, you'll notice that I didn't include patents in the list of intangible assets that are not amortized. So patents, in fact, are amortized, and patents have different lives depending on where they're issued, Canada, the US, or an international patent. But generally, they range between 17 and 20 years of legal protection. However, they are frequently amortized over much shorter periods of time, because the general rule is to amortize them over their estimated useful life, and the useful or economic life may be significantly less than the legal life because of the threat of competition introducing products that may shorten the expected period of future benefits. All right. Next point, an example of how we calculate depreciation using the straight line method. So the objective here is, first of all, at your level, is to determine an annual depreciation expense, just for simple questions that deal with annual financial reporting. And the way to calculate this is to apply the following formula. We're going to take our historical cost, subtract from it our estimated residual value, and this difference is called the depreciable amount. So what this represents is your net cost of owning and using the asset. For example, let's suppose you buy a car to get to and from school during the 4 years of your undergraduate education. Let's say you buy a 4-year-old Mazda 3 and it costs you $12,000. You expect to drive it for 4 years, and at the end of 4 years, sell it for $6,000. Well, your net cost of owning and using the car for 4 years would be your cost of 12 minus what you expect to recover of 6. So your net cost of using the car would be $6,000 over 4 years. And if we divide that by your estimated useful life of 4 years, that tells you that your average annual cost of using the car is $1,500 a year. And so that would be your annual depreciation expense. Now, if you have a period where you are reporting for a business and you're interested in determining the depreciation expense for a partial year, then you just have to prorate the annual depreciation expense for the proportion of a year. And the way we typically do that is by calculating a monthly depreciation expense by taking this annual depreciation expense and dividing it by 12, and then multiplying that monthly depreciation by the number of months in the part of the year or the short year. And for a complete example, you can see the demo question 8.4 that we did together in class. Now, there are some other methods for calculating depreciation. And I mentioned these before. The two primary ones are the units of activity method and the double declining balance method. Your textbook refers to this as the declining balance, but the example they give is actually the double declining balance. Now, how do we calculate the units of activity basis? What we need, first of all, is a depreciation rate. And typically what this works out to is a depreciation amount per unit of output from your asset, okay? So we take the depreciable amount, just like we did in the straight line method, we divide it by the asset's estimated lifetime capacity in terms of number of units. And then when you want to determine the depreciation expense for a period of time, whether it's a year or a month, you just take the number of units of output for that particular period of time and multiply it by the depreciation rate. There is an example in your textbook at page 42. I'll quickly give you another example from my own experience. Many years ago in 1994-ish, I was with a startup venture, and we were producing special environmentally impervious light fixtures that were embedded in the pavement in highways in Ontario and around the world. And we had to produce these with some electronic guts and fully encapsulate them in plastic. So that required a plastic injection molding process. And we had to pay $75,000 for a mold. The mold would produce, I think, 3 parts. It had 3 cavities. And each cavity could do up to 500,000 parts. So that whole mold, which cost $75,000, could produce a maximum of 1.5 million parts. And so if you took the total cost of $75,000 and divided it by the lifetime parts of 1.5 million, you would get a depreciation rate of 5 cents per part. So then in a month, if you produced 100,000 parts, you'd multiply that by 5 cents each, and you'd have a depreciation expense of $5,000. So that's how that system works. Now, the double declining balance also needs a depreciation rate. And the way this is determined is that we take the number 2, if we're using the double declining balance, and we divide it by the product's estimated useful life. So for example, if you have an asset expected to last 10 years, 2 divided by 10 is 20%. If we were using straight line, we'd be using 1 divided by 10, or 1/10. So this is why it's called the double declining balance. So now we have a depreciation rate of 20%. And what we do is we apply that depreciation rate not to the depreciable amount, but to the net book value updated every year. So the depreciation amount in any period T is equal to the preceding year's ending net book value times this depreciation rate. So for example, if we have an asset for $100,000 and we're using this method in the first year, the depreciation amount would be 100,000 times 20% would be $20,000. In the second year, the net book value that we start the second year with would be the $100,000 minus the previous year's depreciation of 20. So now we have a net book value of 80,000. So the second year's depreciation charge would be 80,000 times 20%, or 16,000. So what you can see is the annual depreciation charge decreases every year. And one place where this is, one group of assets where this is a common type of depreciation is assets that are based on a new technology, and we've got competition developing competitive products all the time. And so we think that we might derive the highest benefits from our products produced by this asset in the earliest years. And then as time passes and the competition increases, we think that we'll get less revenue, and therefore we're going to match less depreciation each time. So that's when the double declining balance method tends to apply. Now, although we don't use the depreciable amount, the residual value still comes into play. And what happens is we stop taking depreciation when we reach the residual value. It might even be possible that when you get to maybe the 4th or the 5th year, if you claim the full 20%, you'd actually depreciate the asset below its residual value. Well, in that case, you simply wouldn't take as much depreciation as the formula prescribes. All right, so these different methods, they impact the annual depreciation expense amount only, but we still calculate cost, accumulated depreciation, and net book value the same for all methods, okay? Now, here is an example of how the declining balance method could be applied to one of the questions we did in class where we used the straight line method. So I'm giving you this just so you could compare it to your notes from class about how the annual depreciation expense pattern looks completely different, okay? But by the time we get to the end of the fourth year, the accumulated depreciation is still the same, and we end up stopping the depreciation when we reach the estimated residual value. So you can review this slide on your own if you're interested, but I don't think you're responsible to make these types of calculations on your final exam. All right, one of the other things we need to be able to do is account for the disposal of long-lived assets. There are 3 steps to this. The first is to calculate the depreciation expense for the partial year up to the date of disposition. So this is updating the accumulated depreciation and net book value right up to the date of disposition. Then we calculate the gain or loss by taking the proceeds of disposition, and I've just put brackets around that so that we know that that's one number. So that would be the amount you sell the asset for, and subtract from that the net book value, which was updated in step 2. So if you sell an asset for $15,000 and the net book value was 10, you're making a gain of 5,000. If the net book value is 10 and you can only sell the asset for 5,000, you have a loss of $5,000. So that's pretty simple. Now, when we go to process transactions for long-lived assets, then the first transaction we have to process is acquiring the asset itself. And here we're going to create or increase the long-lived assets at the cost amount, and that goes on to the statement of financial position. We increase long-lived assets and we decrease cash or increase an account payable, both of which are on the statement of financial position. So the acquisition of a long-lived asset does not affect the income statement. The next transaction type is to account for depreciation expense. In this case, regardless of the method you use to calculate the amount, we're going to increase depreciation expense on the statement of income, and that will be a positive number, the way we've been doing it using the expanded accounting equation. And also, we're going to increase the accumulated depreciation account, which is a contra account, on the statement of financial position. And because it's a contra account, I like to use as a default the opposite sign. So we would be increasing the accumulated depreciation account by entering a negative number. Finally, we have the third type of transaction is disposing of a long-lived asset. In this case, what we do first of all is increase cash for the proceeds of disposition received if we are being paid in cash. And then, because we're selling the asset and it no longer exists, we are going to eliminate both the cost account and the associated accumulated depreciation account. So they both end up being 0. So you have to be able to know the balance in those accounts so you can include in your transaction processing a reduction of the cost account, which is a negative number, and a reduction of the accumulated depreciation account, which is a positive number, okay? And those amounts are based on having updated that balance. Now, those three items, cash, long-lived assets, and accumulated depreciation, they're all in the statement of financial position. There is usually one other amount that's required, which is the gain or loss, and that goes on to the income statement. Okay, so how do we present these assets on the financial statements? First of all, we categorize the assets. So we've talked earlier in the course about current assets, and that is a major subclassification of assets. Another major subclassification is long-lived assets. But within long-lived assets, we have major categories such as property, plant, and equipment, intangible assets, long-term investments. And there may be others, but those are the main ones. Now, within each category, we will list key components. So, for example, within property, plant, and equipment, we might list land and buildings, machinery and equipment as separate categories. Under intangible assets, we might list trademarks, we might list technology assets, which would include patents, okay? Now, from either component, we have two ways to present these. And what your textbook shows is that for each asset category, such as property, plant, and equipment, or technology assets, we'll list the cost. We'll show on the balance sheet a deduction for the accumulated depreciation, and then we'll present the net book value. Now, I personally tend not to do that because I find that clutters the balance sheet. Instead, I will put all that information in a note, and then I will present on the face of the balance sheet, just for each category of asset, such as equipment, patents. I'll use the word net in brackets, which means something has been subtracted. What has been subtracted is the accumulated depreciation. So each of my asset categories will be presented as, for example, equipment, net, and an amount. And then it'll be cross-referenced to a note where we will present the details of the cost less the accumulated depreciation. There is an example of A in the textbook at page 41. Okay, I'll open it up now to questions and answers related to chapter 8 or anything else. I see that I got one other question. It looks like maybe I was forgetting to share the screen. Julian, yes, there is a slideshow that you're supposed to be able to see, and I guess I forgot to share it. Should have done that from the beginning. I might have to re-record this. So if you want to see some of these slides and ask further questions, let me share the screen now. That was kind of silly. And let's take questions if you guys have some.
Well, I mean, I had a question just about whether there was any like Excel spreadsheets to make more sense of this, or like any efficient ways of calculating all this stuff.
Did you go to the class last Friday?
I was not there.
Yeah, so I presented those in the class. So for example, I can show you one. Let me see. Let me stop. Actually, let me just see if I can bring that up.
Also, while you're bringing that up,
Well, hang on, I'll deal with your second question in a minute. Here, for example, is so here was a slide that we did in class, and you can probably get copies of this from one of your classmates. This is what I call an amortization schedule for fixed assets, where we, for each of the years that we're doing some financial reporting, we keep track of the cost in a separate account, and we recognize the depreciation expense that is charged every year. We accumulate it in the contra account. So after 1 year, the balance in the accumulated depreciation account is 13.2. After 2 years, we add 2 years together. Okay. So as the accumulated depreciation account is growing, we can subtract it from the cost to determine the asset's net book value. So this schedule is created from some of the input data that's in the question. So this was question 8.3. And the input data included the cost, the date we put the equipment into service, the estimated useful life, and the residual value. And from this data, we calculated the depreciable amount, the annual depreciation expense, and a monthly depreciation expense. And then with this information in the amortization schedule, such as the depreciation expense, then we went and processed the recognition of depreciation in our usual expanded accounting equation worksheet, So for example, Victor, we identified the annual depreciation amount, and how we accounted for that transaction was firstly to charge the depreciation expense on the income statement, and then to increase the amount that we're accumulating in the contra account by the annual amount. Okay.
Yep.
So yes, I mean, basically we use the same kind of transaction processing schedule in Excel, but I also created this other way to track and determine what costs we were going to process in the transaction processing schedule.
Yep. Cool. I appreciate it.
Okay. Anything else, Victor?
I think Julian had a question.
Sorry about that. You answered it while you were explaining it to him.
Okay, good. So Julian, I gather from your question that all you perceived in this office hours was me speaking, right?
Well, I tried to type it down as quickly as possible. I did miss a couple things though.
But you didn't see any slides at all.
No.
Okay. Yeah, okay. So one possibility is I might create a PDF file of this slide deck, and then you can maybe follow along with the PDF file. Also, when I upload this video, I will put captions on it. So if you couldn't write down everything I was saying, you know, the captions will at least give you a version of the text.
Okay. Also, I was gonna ask about the office hours video from last week. Was that posted to
You know,
the...
I posted it, but I don't think I put the link. So I will put that up tonight. Okay.
Okay.
This thing actually, these videos actually take a long time to process to get something that I can give you a link to. I don't know why it takes Zoom so long. It just does. Anyway, it is available. Did you subscribe to my channel?
Your YouTube channel?
Yeah.
I'm not sure.
Because if you
I did by
subscribe to
accident.
it, then you'll at least get a notification that it's available. If I'm a little bit tardy in putting the link up on the course website.
Okay.
All right. Anything else, gentlemen?
I was gonna ask, you brought up 3 different long-term assets. You said, what was it?
I brought up 3 different methods of depreciation.
Oh, no. You said plant, whatever, intangibles, and then you said one more, investing something.
Investments in other businesses. So let me give you an example here. Where is it? Which slide is it on? Yeah, here we are. Okay, let's try this. So the major categories of long-lived assets were property, plant, and equipment, intangibles, and long-term investments. So these are usually strategic investments in other businesses. For example, are you familiar with the company name General Electric?
Yep.
Okay. So General Electric has 1,000 subsidiaries, which means it has investments in 1,000 other companies. So those might be listed on specific statements, but you're not actually ever going to see the statements that list those other investments, because they actually present the statements in what's called a consolidated format. And this is way beyond the scope of this course. It's a fairly complex concept. Even in the consolidated statements, some of the investments in other businesses may be sufficiently small, like if they're just an investment in like 10% ownership of the business, then they might be listed as investments in other businesses. And because General Electric has so many, there's probably only one line on the balance sheet that says investments in other businesses, and then you'll go to a note and it will list, 100 different businesses. Okay. but you know, we're not going to cover this in this course. But you are going to be responsible for tangible assets, typically property, plant, and equipment, and intangibles. Now, there are actually some other categories, some of which are tangible. For example, there's a category called biological assets, which is like
Cows?
timber lots,
Oh,
livestock,
okay.
right? So that, like, if you're running a ranch or something, or if you're running a dairy farm, then your cows that produce milk, they're biological assets, right? But we don't get into all those different categories. There's also another category here, which is other natural resources, such as minerals that you mine, or oil reserves, right, that you drill. But for this course, it's mostly property, plant, and equipment, and intangible.
Cool.
Okay. Good
That's
questions,
awesome.
Victor.
I appreciate it.
All right. Anything else, guys?
I'm all right.
Okay. Well, Victor, we'll see you Friday. Julian, what class are you in?
I'm in the Friday class from 12 o'clock to 3 o'clock.
Oh, the same as Victor.
Yep.
All right. We'll see you both then. Please be sure that you read chapter 9 in advance.
Yes, definitely.
I sure do it.
All right, guys. Good night.
Good night.
Have a good one.
Thank you.